You know, in looking at this kind of forecast, I'm usually doing this in January, not in September. And so what I thought about is doing it around kind of the equity investments strategy focus of this particular conference. And in particular, and by the way, these slides will all be available on our webpage, which is on the little pad of paper you have in front of you, www.marquette.edu/CRE, Center for Real Estate. And you know, when I was looking at stuff to talk about with the panelists, I really came across this CoStar slide, and it troubled me. We're all in the Midwest. I trust it troubles you. It looks as if the commercial real estate. Anyway, I was troubled by the fact that the Midwest has done so poor relative to some of the rest. You go, is that a bad outcome or is that an opportunity? And so I thought we should think about this as maybe as an opportunity, maybe not. Maybe what we really should be doing is staying away from Midwest real estate. And so let's take a look at a variety of things that can defend this in one way. In overall, I think the best way to look at this is to say, okay, what do you do when you invest in a real estate deal? You look at the IRR. What's the internal rate of return? So that's a total rate of return. And the total rate of return is going to be a function of the income stream, which is the cap rate, plus a growth rate. So you might want to have an IRR of 10% unlevered, where you have an 8% cap rate and a 2% growth rate, let's say. So with that kind of structure in mind, let's go through a series of slides that we can that speaks to some of this. You know, additionally, when you start looking at the Midwest, we can look at the Midwest and say which property type within the Midwest might be the one to think about. And you can start to see here in particular, the yellow line on the bottom is the office market, and the office market hasn't come back at all. Matter of fact, that's at 80 cents on the dollar of where it was 10 years ago. Okay, so you go, so Midwest now and maybe property type. From there, another set of slides from the same CoStar materials. Here we look at the solid line is the non-prime markets. The prime markets differ from property type to property type, but it's usually the top 7 or 8 markets that these properties trade in. And I thought there was somewhat interesting information in this, in that when you look at the yellow one, I can't, when you really look at the office, apartment, and retail, all have a pretty big gap between prime markets and the other markets, but when you start looking at industrial, not so much. So embedded in that is there's some, to me, some information, okay? So let's go on. So with that, it's kind of a quick backdrop around what we might want to think about when we're going to invest in real estate here in the Midwest. Let's go through a little bit of background that might help populate that decision. So we always start with growth. GDP is the broadest measure of economic growth in the United States. It's bounced around. We're at about 2%, okay? From there, you go, well, what does the GDP look like, growth rate look like on a state-by-state basis? And this is only over the last year, but you can start to see that Wisconsin did okay, not well, as was the case with most of the kind of east central Midwest, Wisconsin, Illinois, doing okay. When you look at some of the areas compared to us, you go, boy, Minnesota and North Dakota and other areas look to have done better than what we have. So we're not doing real well, even relative to our neighboring states. And I hope this can be adequately seen. And so I thought, okay, maybe one of the things we should look at is economic growth for Wisconsin and Illinois relative to the United States. And you can start to see that economic growth, and this goes from 1997 to 2012, largely for Wisconsin is about 2/3 the national rate, where for Illinois it's about 60% the national rate. So that starts to go to that growth factor we might want to put on in our analysis, okay? So this should hopefully help you populate that. So what we saw is about a 40% growth rate in the United States, about 25% for Wisconsin, that difference being 15% across about 15 years. So Wisconsin's GDP growth rate is about 1% less than the nation as a whole, roughly speaking, okay? Let's go on. From there, another way we can start measuring growth or how it's revealed and how it creates demand for real estate is through jobs. And what we have here are jobs that are largely underwhelming on a national basis. And I say largely underwhelming when we really come out of the recession that we have. One would have expected far greater job growth in the years 2011 and 2012. We've barely had enough job growth to absorb the new college graduates and others coming out of this institution and others, much less reduce the unemployment rate. But with that said, our unemployment rate now is down by to about, 7.3%, so almost down 3%, and we have absorbed some of those jobs back into the marketplace. What you see here is a slide that I've used time and again. It's a great one from Calculated Risk blog. And what they provide you here are all the recessions since World War II. And when you look at the red one on the bottom, that's the current recession. And then you go to the one that goes out a little further. That was the most recent recession before that and the one before that. So what we're seeing is the most recent recession, the one we just came out of, was quite a bit deeper. We lost 6% of jobs, and 4% of that is back. So we're roughly 2/3 the way out of that hole. But recall that we're 60 months into this recovery, and we have new people coming into the job market as we go along. So we should have really come back out of this in about half the time. One of the challenges with this is this idea of workers opting out of the job market altogether. And so what's really happened, as you can see in the slide, especially on the right-hand side, is we have a reduction in the labor force participation rate from about 67% to about 63%. And the conventional wisdom was that, we've got people who are baby boomers who are leaving the job market, and so it's a natural thing that should come down a little bit. Also, we had this recession. It's going to come down a little bit more. But when we start looking at that a little bit more closely, and I hope this is visible, it might not be easy for you to see, but if you look at the right-hand portion of this particular slide, you'll see the labor force participation rate for the 25 to 44-year-olds, that's the top line, actually coming back down to about 81%. The green one in the middle dropping a good 12, if not 16% from the earlier 2000s and such, is the 16 to 24-year-olds. So there's a lot of those folks returning home from college without a job. And so not the real estate students, okay? We've done well. Placed them all last year, and we've all but one this year. So what we have here is that labor force participation rate is actually reduced for the younger cohorts. And the interesting and ironic thing is the folks who are older than 55 have actually had the biggest increase in the labor force participation rate, kind of breaking the received wisdom that it was the baby boomers who are exiting the labor force pushing this number down. It really is the young adults that have pushed this labor force participation rate down. When unemployment comes down a little bit further, folks, these folks will enter back into the job market. So to really push the unemployment rate down much below the 7.3 or 7.0% rate that we have will be difficult because these folks will come back to the market. Looking at unemployment, this is actually fairly positive. These are weekly unemployment insurance claims from people who've been recently laid off. When we start getting down about 350,000 on a regular basis, that usually ticks over to what might be closer to a 200,000 increase in jobs every month, but we're still at that 169. That's why a lot of the economists are looking at this number in particular, saying, gosh, we're not seeing many unemployment claims. We should have better jobs numbers than we do, and we don't. We haven't quite been able to crack that. So let's go on. So when we start looking at unemployment, or employment, I should say, in Wisconsin, Illinois, and the United States, here we don't look so good from a percent basis. So once again, what I'm trying to do is say, is the Midwest, and in particular Wisconsin and Illinois, maybe a good place to be given that first slide? And you start looking at this and you go, Illinois has barely gotten back to even, And Wisconsin's got maybe a 1 or 1.5% growth rate to the United States 1.4% growth rate. This is, again, across a number of years, so we can spread some of that across the years, but it really shows pretty big weakness both in the United States as well as here in Wisconsin. And then from there I said, okay, there's one other thing I could start looking at. A lot of the economists are not willing to go out for 10 and 20 years and project job growth in any sort of credible way. But one of the things you can do is you can get what's called the population growth numbers. The census is willing to put those out. And I looked at some of those, and this revealed some pretty, I almost want to say, challenging, almost disturbing numbers. Between 2000 and 2030, the United States population growth rate will be about 1% a year, non-compounded. You know, across 30 years, a 29% growth rate. If you start looking at what Wisconsin's going to look like, it's about half that. Or we're ranked number 28 out of the 50 states, or 51 states, including the District of Columbia, with about a 15% growth rate. So maybe 55% of the national rate. But Illinois is significantly down at about an 8.2%. So once again, it goes to where you might want to be and put your dollars. And this starts to go to the discussion about Paul and some of these other folks going, I really want to be in those maybe higher growth markets than what we have here in Wisconsin. But even if we do in Illinois, but even if you do go in some of those lower growth markets, there are going to be corridors within those that might provide some very good growth for you. So let's go on. Let's talk about inflation for a little bit, as that feeds into maybe Bernanke's decision to taper more quickly rather than less quickly. What we have is Bernanke wants to see inflation and using the CPE at about 1 to 2%, and that's where we are, roughly 1 to 2%. The two big things that figure into that are labor costs and commodity costs. We've gone through this before. When we start looking at unit labor costs, the cost to produce an additional unit have really been well behaved. When you start looking at the last 5, 6, 7 years, we've had maybe a 1% inflation a year with a bit of noise in the data. And after some pretty big oil shocks, the commodity prices, as revealed by the producer price index, has been fairly well behaved as well. So not a lot of inflation pressure, which gives the Federal Reserve some comfort and not wanting to taper far too quickly. So that's just a quick background on what might happen from an interest rate point of view as well, because that figures into that. So let's talk about housing. More from a context as well as what might create demand for apartments or not create demand for apartments as well, because it's either, if you're going to create a household, the tenure is either going to be rental or ownership. When we start looking at housing and what housing might be doing, this comes from a calculated risk as well. When we start looking at the right-hand part of this slide, we've got months supply. And you've got month supply of existing homes approaching 4 months. Now, the historic average has been about 5.5 months. So we're below historic averages, approaching what might be more of a seller's market than a buyer's market. Interestingly and important, the blue part of the graphic there, which is on the left-hand side of the chart, reveals that the change in existing home inventory is negative. So what we're doing is we're actually, over time, pulling some of those out, which will pull down those units available as well. I think that shows for some pretty bullish news for housing going forward. This slide being one I've showed you before, if you've gone to some of my IREM presentations, these are real house prices, so it's inflation adjusted. It's using the big indices. And interestingly, we went to kind of we reverted to the mean of about 100, so we're right at inflation for how much housing has grown. And it looks like we've hit the bottom. We've seen these numbers from the Case-Shiller-Weiss, as well as our own journal, Sentinel, saying, we've got increases in the number of housing units sold, as well as the price change. And our price changes are about once again, maybe 2/3 to half of what we're seeing on a national basis. I don't like making that comparison because we have some of those really outlier markets out there that have seen great volatility, and I'm not sure that's what we'd want to compare against. These are really solid median price changes. One other thing that's starting to happen, and we're seeing home ownership rates really revert to the mean. If you look at this is a very long-term series going back to whatever, the 1960s, you'll see that the home ownership rates has hovered right around 63, 64%. That grew a lot because we had new mortgage alternatives for them. And guess what? Those new mortgage alternatives went away. And so what happens is the home ownership rates, that growth rate is going away as well. It looks like we'll revert to a home ownership rate that might be 0.5% or 1% higher than the 64% historic numbers. What will challenge that a little bit, and one of the reasons why I'm a little bit concerned about this, all of a sudden this great burst in housing, is that you look at median income, and especially we're starting to see wage growth being really great, but a lot of that is being captured by the top 10% of the wage earners. When you start looking at median household income after adjusting for inflation, we're off by about 5% since the Great Recession. That makes it more difficult for homeowners to buy a new home. So, and leaves them less confident too when they start realizing, I'm not keeping up with inflation. I'm not sure I want to get into that 30-year plan of a single-family mortgage. This is a little bit of a difficult slide to read, but this is an important slide to understand. What we have here is, and I'll show you another one using different numbers in a bit, but this is the Federal Reserve survey of banks and whether or not they're loosening or tightening their credit standards, in this particular case for single-family mortgages. And a 0 means banks are neither loosening or tightening. If you go above 0, they're tightening. If you go below 0, they're loosening their standards, okay? You'll start to see across time, and by the way, it's broken up into two different pieces because we had all mortgages for a period in time going to about 2007, and then what happened is they were able to slice out the conforming Fannie Mae from the subprime and other types of mortgages. But you can start to see, starting in 2007, which is the component piece on the right, underwriting standards went up dramatically, okay? And you'll start to see that they're not tightening anymore, but here's the challenge. They're not loosening. So they got tighter. When you have this tightening, you need to also see some loosening. And when it comes to single-family mortgages, we haven't seen a lot of loosening, making it quite difficult from an appraisal perspective, as well as underwriting the incomes, as well as the credit scores, for some of the folks who are in the middle of that underwriting process, okay? So that bodes a little bit ill for the single-family home market. And I fear a little bit what might have happened with this nice pop in appreciation that we saw could be attributable to the same type of effect that we see in the mortgage markets when we have interest rates tick up. So what happens is we're all kind of sitting on the sidelines waiting to refinance. And we're going to be the smart ones on the block, right? And so it goes down an eighth, and hey, I can save another eighth, and then it goes down another couple basis points, pops up a little bit, but then it continues to drift on down, and you go, I've done the right thing, and then all of a sudden it goes up by a quarter. None of us refinance at the bottom. We refinance after it ticks up a little bit, okay? And so what I'm fearing with the current step up in single-family interest is exactly that. They felt they missed the bottom of the market. We had a short rush of folks into the market, and will that be sustained is the question. I'm a little bit suspect given this data. It's still hard to get a mortgage, and folks don't have the income as well. And this bodes ill then for those of us who own a home and look to step up. What we have here are a series of different price ranges for homes. And starting with the lowest price ranges on the bottom. And you'll note, and this goes over, about a decade, and you'll start to see that the lower two tiers are probably the starter homes for a lot of folks. It's the first-time home buyer market. And if you really look at just what those two tiers are doing, they are going down, down, down largely across time. And if we don't have that first-time home buyer coming back into the marketplace, it's pretty hard for someone to go into the step-up marketplace. So I'm a little skeptical. I hope I'm wrong on that from an economic driver perspective, but I would be careful to think that we're back on track with single-family residences at this point. It does look like there's a dearth of supply out there, but I have some concerns given maybe the inability for people to purchase some of those homes because of the underwriting and such from a demand perspective. Let's talk about commercial real estate. That's why we're here. You saw this slide. This slide's a transaction volume, and if you can't quite make it out, it's transaction volume by quarter. It's real it's real capital analytics data. And you'll start to see in 06 and 07, we had those huge spikes in transaction volumes. The different colors are different property types. And you can start to see that the volume tailed off to about 10% of its previous year's volume in 2008 and 9. We're now back to the 2005 and 6 levels, which I think are reasonable and sustainable levels. I don't think maybe some in here would certainly like to get back to those transaction volumes of 2007, but I think that was a kind of a frothy time in our history. This isn't a real easy one to see, and I apologize for that. This comes from the mortgage bankers, but I think it's a little bit of an interesting one from a commercial point of view. You'll start to see that we have the 07 and 08 years when we still had a lot of liquidity. The black line or bar is multifamily. The green one is the other commercial loans, and then the beige one is the combined. And you'll start to see banks were net lenders into the market in 2007, in early 2008, but after that, they were net negative lenders for most of the period for commercial. And you look up right up to the current day, they have been largely net negative lenders. So you'll note that the green line is not positive across this entire horizon, but for two little points or two little quarters. So there still is a reluctance from a commercial lending point of view to put money into non-multifamily product type right up to the current time. With that said, we can look at some of the same data from the Federal Reserve looking at commercial real estate lending. And the top chart is the commercial real estate lending. If you go above the zero once again, that means there's been credit tightening. You go below it, it's loosening. You'll start to see that we have loosened and we continue to loosen right up to the current time. That's the top part of the chart. The bottom part, if you can't read the title, is the demand and the interest in taking out new mortgages. And you'll start to see that the interest has come back rather nicely as well. Okay, so I think we're starting to turn the corner maybe on some of the commercial real estate mortgage markets. Let's look at the property markets. Then we'll kind of summarize this stuff at the end. Let's look at retail. You always have to start with retail. Retail sales is really about 70% of GDP. So if we don't have retail sales, if we're not purchasing things as consumers, we're not going to have economic growth. And you'll start to see on an inflation-adjusted basis, retail sales are now higher than they were in the peak of 2007. And so we've come back. One of the challenges, this is a different way of putting up their information, that U.S. workers are not making as much as they did on an inflation-adjusted basis several years ago. They aren't big negative numbers, but you feel it. You're not making as much. And then you're just not as confident about going out and maybe buying durable goods. But here's the interesting thing. Even with that red part, when we start, maybe this helps us out. I'm one slide ahead of myself. This is a slide that I've used time and again as well. Some of you have seen it before. What we have here is the disposable, household debt service payments as a percent of disposable income, household income. So what's really saying is how much I have to pay of my income out on debt service. And we're at some of the lowest levels we've had since they've collected this data, going right back to the 80s. We've got some dry powder if you're retail to put into purchases. So we've really reduced our payments across time and reduced them dramatically. We have delevered, is what this is saying, or at least delevered from an interest cost perspective. This is an interesting slide, which I didn't quite expect to see these Robusta numbers, and they're really important numbers to me from a retail perspective and from a consumer mindset perspective. If you start looking at this, you'll see the biggest growth. The big blue charts here are, the first one is cars and parts. The second one is building materials, and the fourth one is furniture. Those are all what we call durable goods, things that you purchase that you expect to have for at least 3 years. We start buying durable goods different from non-durable goods, which are clothing and food and such, when we're more confident about things. And the fact that that part of spending is growing is really a great thing. The negative pieces, department stores, well, what's happening is we're not spending as much on non-durable. Something has to give. But overall, that's a sign of confidence in the marketplace. This is one that for anybody in retail, you should go back and take a look at this article. This was a Wall Street Journal article from about 3 weeks ago. And what the Wall Street Journal article was about what our panelists spoke to 1 year ago. They started talking about this omni-channel retailing, where you have to be online, you have to be brick and mortar, you have to be you have to have a variety of ways you're selling your goods. What we see here is that the top line is Amazon. Amazon has over $60 billion in sales a year. And when you start looking at Amazon, you go, okay, well, good for them. But the interesting thing below that, and I need to get to my numbers here, sorry. The interesting thing below that are how small internet sales are for some of the biggest retailers out there as a percent of their overall sales. So if you look at Walmart, which is in that mess down below, they have $7.7 billion in internet sales last year out of $473 billion in retail sales. It's nothing. It's 2%, not even. And you go, okay, yeah, well, that's Walmart. You kind of go there to get your commodities, right? Well, let's look at another one. I have the numbers for Best Buy. Best Buy sells $3.3 billion of their goods through the internet out of $48 billion in sales. So there's 6 or 7% of their sales being online. That's a commodity that you'd expect people would go to and buy from their online. The reason why we have this messiness, there's 12 retailers there. The next 12 largest retailers in their sales do not equal what Amazon does. What this is saying is the idea that retail sales on the internet are going to dominate brick and mortar isn't happening. And I'm actually using some of this in my own world as the dean, saying when I start looking at these online learning opportunities, some of them are very, very good. But you go, and will that take over for the education, for the Marquette education that we have here? And that's a very scary proposition. And at one point, I believe you can learn a lot online, but I think we have a transformative experience at a university, and certainly at Marquette University. And the idea of learning online, that's one thing, but what's going to happen and what we're doing in the Real Estate Center right now is our learning is an omni-channel opportunity. We're flipping the classroom. We're using the internet. We're also teaching in the classroom as well. But I think this is really interesting. It was really embracing for the need for retail in a rather important slide. So you may want to go back and get that Wall Street Journal piece or go online. So overall, what you're starting to see is some kind of positive news, at least from my perspective, on the retail game. Let's look at apartments, another really good sector, and it's going to stay that way, I think. This is a messy slide, but it goes back to 1956, I believe. And since 1956, the average multifamily starts were 360,000. We've seen a big spike up in the last couple of years, but where are we right now? At 290,000 units. If we have a household growth of about 1 million or 1,000,001, which we'll get to in a minute or two, and about 35% are multifamily, 1.1 million times 35% means we're going to have a demand of about, what, a little less than 400,000 units. We're not building enough to accommodate that at the current time. So from a supply perspective, still looks like multifamily is pretty safe. When we start looking at the pent-up demand from households not being created during the economic downturn, that's exactly what this graph is trying to show you. You can start to see in 06, 7, 8, 9, 10, 11, we had about 500,000 to 600,000 new households created. What should have been created, given the population, should have been closer to 1.1 million. That's what's on the right-hand side of this graph. And by the way, if you're in multifamily, you really need to go to the Joint Center for Housing Studies, at Harvard, and look at this stuff. It's very good stuff. But what we have here is about almost 3 million households that haven't been created, but will be created once they have jobs. It's that young adult group that came back home that will eventually rent and then likely own. We have a pent-up demand, even if this is 3 million divided by 350,000 a year, that's 8 years of potential demand, nothing else, okay? Here's a slightly different way to look at it from the same publication, and they simply use not households, but they use population. The one thing that's a little bit different here, the pent-up demand numbers would largely be the same, but the one thing that was a little bit more troubling here is the years before 2007, we actually had maybe an overcreation of households, as maybe more people left the houses. It was such a good time. So maybe we don't have a close to 3 million pent-up demand. It might be closer to 2.1 or 2.2 million. Make your own decisions. Go take a look at the research. I think it's interesting. This goes to what we're seeing as lower incomes. If you have lower incomes across all the different cohorts, what are you going to have? You're going to have probably more people renting. Okay? From there, I thought this was another really, if there's a handful of slides I think are particularly important, here's one of them. When you start looking at demand over the coming decade, this demand is going to come from one of two areas. One is minorities and the other one's seniors. This is households. They're going to create households. We don't know whether they're going to select multifamily or single family, but if you look at minority homeownership rates in the United States, both Hispanic and African American, they're about 50% homeownership rates, maybe 48%. So as we have more Hispanic and African American households coming to the marketplace, there will be a much greater demand by those racial groups. Additionally, the older folks, the seniors, are also going to create some demand for multifamily as well, which is kind of interesting. This is a little bit messy. Once again, I'm ripping off of the Joint Center and their work. They're very good work. But if you're to look at this, you can see the top two colors are the reddish and the whatever it is, the darker beige. And those two start to say those are the highest occupancy rates for multifamily. And what's interesting is right around the Midwest, you can see those are all solid markets at or above 95% occupancy rates. There's really no weak markets, and I think one of the reasons for that is we really haven't seen much new supply on a relative basis to other markets in the United States. Once again, what I'm trying to give you is some background information to start thinking about whether it's a good idea to invest in the Midwest versus elsewhere. Let's go on, and I'm combining office and industrial in some ways because they largely have some of the same drivers. What we have is capacity utilization, so how much of our factories are we using? We're using a reasonable amount. We really dip down, but we're back to a reasonable amount. You want to be right at about 80%. We're roughly there. You go above 85%. We end up having supply, inflation in all likelihood, And so you don't want to be too high or too low. I think the porridge is just right. This goes to manufacturing a little bit. Manufacturing was out of favor for a long time, and we're starting to hear more and more about that. I want to talk about that in the next several slides. One of the things you see here is what we grew out of as far as these are hours worked by manufacturing employees after each one of the more recent recessions. And you look at the dark line on top, and that's the current one. So even though you saw that unemployment rate dip down and we really aren't coming back, one of the things that is coming back this time stronger than it has been in the past is manufacturing. And we have one of the largest bases in manufacturing, if not the largest base in manufacturing, within 100 miles of right where we sit here. This is important to us here in Milwaukee, Wisconsin. Here's another interesting one as well. This is looking at unit labor costs. I gave you some of that earlier when we started looking at inflation, but this is looking at unit labor costs relative to other economically advanced countries. And you can start to see the cost to produce a manufactured unit has dropped by about 25% over the last 13 years, so about 2% a year. We are more efficient with what we do. We're more efficient, and we've dropped more than the other countries, meaning it'll make it easier for us to export things to Europe if they come out of their slump. And they'll come out of their slump, okay? And this is an interesting slide, once again, for those of you who are in manufacturing. I would definitely encourage you to go get the Boston Consulting Group report or the Wall Street Journal article, because what they're doing here is they're looking out to 2015 and to 2020 and say, how competitive will we be in the United States relative to other countries, including China, from a manufacturing perspective? And what's happening here in the United States is natural gas is coming way down in cost. That's a big manufacturing item. Labor rates have come down when you start measuring labor and a per unit of production efficiency measure. And what they're starting to show you here is that even China on the bottom doesn't have much of a manufacturing advantage over the United States in 2015. Some of this has good and bad news written on it. It's good news. We will be competitive internationally. The bad news is would be some of the Harley, the Mercury Marine, and Kohler two-tier wage systems that have been put forth, where new employees come in at a much different wage rate than the existing employees. It makes us more competitive on one hand. On the other hand, we may not have family supporting wages with some of those jobs, which might not mean they can support a purchase of a home. So this looks really good on its own, but it does cut both ways, and we should realize the impact of that when we're looking at some of this. You know, the oil boom's helping us out a lot as well. A big part of our trade deficit it goes to the Middle East, and we know there's all kinds of trouble there again. And so by 2030, most believe we will be oil independent again because of the extraction that can come from North Dakota and in Pennsylvania. That's a pretty big deal from a geopolitical perspective, and it's a very big deal from where our dollars flow. Okay, so from there, a little bit of additional background to create a cloud of information, and this is nationally again. You know, corporate profits are really doing well. The businesses out there continue to make money, and if you start looking at this goes from 1990 to the current day, so it's 23 years. But if you look at that scale, it was profits were about $400 to $500 billion, and now they've more or less tripled. So one of the things that has happened is the worker is working harder but not making any more, which is what we saw. So where does that additional money go? To corporate profits. It either goes to labor or to the organization. In this case, it's going largely to corporate profits, and we can see how that's being in the numbers. From a demand driver for office in particular, I regularly use finance industry. You'll start to see that it did bottom out. There's new finance hires going on out there, but we're still back to only about 2003 as far as the employment levels, or about a decade ago. We really aren't anywhere near where we were at the peak in 2007. As far as office fundamentals, this comes from the Wall Street Journal in Reese. I pretty much concur with what Jack Durberg had to say. Well, we actually had positive absorption in the second quarter, 2013, of 7.2 million square feet, or about 0.2% of the supply out there. That was the best increase we've seen since mid-2010. It really shows that what Jack is talking about, what I was talking about with the GSA, meaning that we're taking more people and putting them into smaller spaces. We're far smaller space per user, or space per employee. So what did I just go through? I went through a mess of stuff like I usually do, but I need to tie it up in some way that hopefully begins to make some sense. And so what I started with here is that the IRR equals a cap rate, or a yield on real estate, plus a growth rate. So 8 plus 2% means a 10% IRR. And if you start looking at the Midwest versus New York, and let's take an example here. And let's take that example of, by the way, I'm not going beyond 5 o'clock. You know that. I will not keep you here past 5 o'clock. I've got 4:54, so I got 6 yet, right? Right, Bob? I don't want to get between Bob and his Grey Goose. So let's compare Appleton and the Big Apple. If you want to buy multifamily in the Big Apple, cap rates are somewhere sub 4%. Some of the better new product coming out of the ground in Chicago is 4 to 5% cap rates. If you go up to Appleton, what are cap rates up in Appleton for multifamily? Somebody? 7.5. So you got cap rates in Appleton of 7.5 versus 4%, let's say, in New York. That means the New York City properties have to grow 3.5% faster than Appleton just to get to where Appleton is. So if Appleton grows by 1% a year, they have to grow by 4.5%. Additionally, and interesting, when you start looking at multifamily in Appleton versus New York, if Appleton's a big enough complex, where are they going for the source of debt? Probably one of 3 sources: Freddie, Fannie, or HUD. Because if it's long-term fixed rate, all due respect to my friends from Associated Bank up front here, but they're going that direction to get the long-term fixed rate debt. And the terms and conditions for New York City are not all that different from Appleton, Wisconsin. I know, my wife works for Fannie Mae, doing exactly that. So all of a sudden, you got something yielding 7.5 versus 4, and your cost of debt is arguably the same. Now, when it comes to some of the other property types, there may be some differential pricing based on perceived riskiness or safety. But what I'm trying to put forth is the idea that maybe in a slow growth market here in Wisconsin and Illinois might be a better place to go if you can get a high enough yield up front, a cap rate of 7 or 8%, relative to what was talked about here with some of the retail products of 5 and 6% cap rates in IRRs of 7 and 8%. And these were unlevered IRRs. But how many of you are buying a retail product that is a 7.5 or 8% cap rate in this marketplace? You don't need growth if that's what you want, is a 7.5% IRR. Because if you have a 7.5% cap rate and 0 growth, you got a 7.5 IRR. All of a sudden, some of the returns start to look pretty good, even if you don't have growth, if your cap rates are high enough. And I argue our cap rates are actually quite close to that. So when you really start looking at some of these marketplaces, and I wanted to kind of bring this back to maybe an equity investment strategy in 3 minutes, Bob, is what you have in New York City and some of these gateway markets and prime markets is you really do have a liquidity. I'm not sure liquidity is super important for a lot of folks. Certainly in this marketplace. But what we might have is the ability to arbitrage that a little bit here in Wisconsin because you have that higher yield, which allows you to get a higher rate of return, especially once you leverage it up. So if I were to start looking at this, some of that arbitrage opportunity goes away for industrial, because industrial looks like it's priced in non-prime markets the same way it's priced in prime markets. So if you really want to do that, it might be better from an industrial perspective to go to those prime markets. From an apartment and retail perspective, because of those big differences in cap rates, I think you have a really good opportunity here in the Wisconsin, Northern Illinois markets. When it comes to office, we have issues with absorbing that space, and we have fairly high vacancy rates in Wisconsin, maybe not for that top property type. So there still may be some demand for that space. And that one still is troubled in both marketplaces. So overall, what I wanted to do here is to provide you with some background things to think about when it comes to an equity investment strategy and why it might make sense or might not. You need to sift and winnow through those numbers and start figuring out what's the growth rate in Wisconsin versus New York or San Francisco. But I think you also have to start looking at the fact that you have to have a far smaller growth rate, and we still do have a growth rate in Wisconsin in economic terms as well as population terms. That is about 60 to 65% of the national average, which might make it a really good investment to be here in the Midwest. And I'm at 4:59. I'm also tasked, and so I guess there's no questions. Ask me out there. I'd be happy to take them, as always. We will have a reception right outside. I really do thank you all for coming out. We had over 300 of you. Please enjoy the cocktails.